Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to look at financial statement of banks. Now, we have looked at final accounts for sole trader, financial statement of public companies, financial statement of partnerships, business. Now, today we want to look at financial statement of banks. Then from here, we'll also look at financial statement of insurance companies. Now, financial statement of banks are quite different from those for manufacturing companies and companies that are into trading of goods. Okay, financial statement of banks, it is different because the operations of banks are not like those in the trading and manufacturing sector where they deal in physical goods and services. Here, banks are dealing with money. They are financial institutions, and the way they trade is different. For example, they don't do any purchase of goods, they don't do any sale of goods, and so the dynamics of preparing financial statement for banks are quite different. I have seen people who have gone through the professional exams, become chartered accountants, and they have been employed in banks, and they are struggling to prepare financial statement of banks because the training of preparing financial statement of banks was not part of the training process to become a chartered accountant. Now, even though the basics are there, the fundamentals are taught. However, the banking sector needs specific training onto for the accountant to understand the nature of their activities and the kind of income they generate and the kind of expenses they make to be able to prepare their financial statement. And so what I'm going to teach you today is to teach you how to prepare financial statement of banks. Okay, now I'm not going to waste much time on this because, in every country, there is a banking sector law, okay? And the Banking Act or whatever code of laws that are applicable to the banking sector kind of affects the way in which financial statements are prepared as well. But what I want you to understand is that here I'm going to teach you a universal approach. Now I'm going to teach you the basics, and it cuts across all banks in all countries, how financial statements of banks are prepared and what goes in as the components of financial statement for banks. Okay, so that is what we are going to look at. Now, in preparing a final account of banks, there are 4 key things that you need to, or let me say 5 components. It is the same as the components of financial statements that we know. Okay, we are going to prepare financial statements of banks, and we are looking at the components of financial statement for banks. And then from there, I'm going to give you the format for each of them, and I'm going to tailor it to suit the operations of banks. And I will let you understand the kind of incomes that they generate and the expenses that they pay, and then the assets and liabilities of banks, and then about their equity. Okay, so without wasting my time, let's look at the components of financial statement for banks. For a typical financial statement of banks, you are going to see 5 key things that are being prepared by the bank. The first one is a statement of income or profit or loss. So income statement, or what we may call statement of profit or loss. And then the bank will prepare statement of changes in equity, in shareholders' equity. And then the bank will prepare the statement of financial position. And then they'll prepare statement of cash flows. And then finally, they'll prepare the notes to the financial statement. So this is, like I told you, it is not different from what we have studied to become chartered accountants or to become a masters in accounting. But then it is going to be tailor-made to suit the operations of banks. That is what I'm trying to let you understand. I'm not saying that when you are trained to be a chartered accountant or a master in accounting, you cannot prepare these financial statements. Actually, you can. But what is going to happen is that you may not understand the rudiments of the banking sector. And that is what I'm going to expose you to. So notes to the financial statements. So the first one, which is income statement, you can also call it statement of profit or loss, so that it will be uniform to what we have in the conceptual framework. Statement of profit or loss. So these are the components of financial statements of a bank, and it's exactly what we do with the manufacturing sector and the trading sector. However, I'm going to make it so specific for you to understand what goes into their income, their expenses, and their assets and liabilities. Now, that is it. Now, in this video, what I'm going to do is that I'm going to pause on the statement of cash flows as usual, because we're going to treat this as a separate thing. In fact, the preparing statement of cash flows of a bank, I'm going to talk about it later. But then, this video, I'm going to focus on the first three, and of course, the notes to the financial statement, which will serve as workings. But I'm not going to give formats for the notes, because you know what goes into it. So I'm going to talk about the statement of profit or loss, the statement of changes in equity, and the statement of financial position. I'm going to give you formats for these three. And then in the next video, we'll take a question and then we'll solve it together, so that we'll understand how to prepare financial statements of banks. And so without wasting my time, let us begin with the statement of profit or loss. Like I said, I'm not going to go into the legal aspects of the banking sector. I'm just going to be focused on the accounting aspects. So I'm going to clean this. I'm going to begin with the statement of profit or loss for a bank. And so I will say statement of profit or loss for the year ended. So show my currency sign in dollar, and then I'll also indicate the notes to the financial statement. So this will be a column. What I'm going to prepare for you is a highly summarized financial statement, and all the details will be shown in the notes to the financial statement. Okay, so I'm going to give you the format for the statement of the statement of profit or loss for a bank. Now, please pay attention as I begin. When preparing the profit or loss statement for a bank, we know that in a trading sector, we would have begun with the sales revenue, and then less cost of sales. Then we have our gross profit. But when it comes to the banking sector, they don't sell anything that you are going to say sales. So you need to understand their source of revenue, and then you indicate it as such. Now, the main sources of revenue for a bank, or let me say the major source of revenue, is interest income. Because banks will take customer deposits, they give it out as loans to customers, and the customers pay the loans with interest. So the interest income is the main source of income. In fact, what you will call sales revenue in the business sector is interest income in the banking sector. So the banking sector will derive their main income from interest. And that is why interest is very important. You go for loan and they accumulate interest income. Now, remember that most of these financial institutions or banks, I want to be specific on banks because there are other financial institutions, okay? I am on banks. I'll talk about insurance companies later. Now, most of these banks, or almost all of them, what they do is that banks also borrow to lend. That is the practice of banking when it comes to loans. They borrow money and they lend it to their customers. And when they borrow the money, they pay interest on the funds that they have borrowed. And then they also charge interest to the customers when they also lend it to the customers. So what is going to happen is that, let's assume that a bank borrows $100,000 at an interest rate of 20%. Okay, and then they lend the same $100,000 to their customers at an interest rate of 35%. So what is going to happen is that the bank is going to pay this 20%. They will pay the bank. So it is an interest expense to the bank. I just want you to understand the concept of how banks operate. Then here, they will also lend it to the customers. So the customers will now pay interest. So it becomes an interest income of 35% to the bank. And so when we net off these two, there will be something called a net interest income. And the net interest income is the interest income minus the interest expense that they will pay. And so in this case, if you look at the same amount of money, paying 20% interest and receiving 35%, then indirectly they are gaining 15%, kind of. So this 15% is what we call the net interest income. Now, the first income source that we are interested as far as this financial statement is prepared is the net interest income. And we are going to show that on the financial statement. The total interest income will be shown, and then the total interest expense will also be shown. But the details of these two will be in the notes to the financial statement. And then we are going to have our net interest income. So the first source that we should be mindful of is the net interest income. And how do we get the net interest income? The interest income minus the interest expense of the bank. Because the bank will borrow and pay interest, and they will also lend to the customers and then get interest as income. Another important income source is commissions and fees. Now, when banks render services to their customers, they take commissions or they take fees. And so what we do is that commissions and fees income are merged into one because they look similar. So for example, if you want to buy a banker's draft at a bank, you pay a commission. If you want to do so many transactions in a bank, they will charge you a commission for that, or fees. Now, if you are operating with a bank and you are using an ATM card, they charge you fees for using the ATM. They charge you fees for giving you a checkbook. They charge you fees on their services or bank charges and all that. So what we are trying to say is that the banks charge commissions and fees on the services they render to customers aside giving of loans. So the interest income is purely related to loans. But when it comes to other services that they render, it is either a commission or a fees they are charging. So another source of income that we'll be interested in is called commission and fees income, which we are also going to show on the statement of profit or loss. And then after we have shown our commissions and fees income, if there is any other income that the bank is also getting, okay, so we can classify any other income together as other income, especially when they relate to operating. So we can say other operating income as a third one. So these are the three main income sources that we are going to look at. The interest income. So to the banks, what you call sales revenue in the manufacturing and sales sector, we will call it net interest income. And then we also have commission and fees income, and then any other operating income. And then of course there will be operating expenses as well before we arrive at our net profit before tax. And so I'm going to clean this rough work that I've done, and I'm going to present the financial statement for you in a very nice way. I'm going to put it here for you to understand how to prepare statement of profit or loss for a bank. Okay. All right. So we begin with the interest income. So you start with your interest income. Now, the details of the interest income will be in the notes. So that is why the column for notes will be there. So it could be note 1, note 2, because interest income could come from so many loans and advances that they have given to customers. And we are going to tabulate all of that in the notes to the financial statement and bring the summarized figure here into the financial statement, interest income. And then we take out the interest expense like I explained to you. So we take out the interest expense, and then the resultant figure, we call it net interest income. So that is how, and the interest expense, the details will also be in the notes, and we will show the sources of borrowing from the for the bank, where the bank also borrowed money before they used it to lend to customers. And then after you have gotten your net interest income, you move to the next one, which is the commissions and fees income. So commission and fees income. Details of that will also be in the notes. So we add the commission and fees income. I know some of you are new to financial statement of banks, and I want you to appreciate it. Now, after we've added the commission and fees income, we look to see if there is any other income that we have. So we'll say other operating income. Now, remember that here I said other operating income. Be mindful because some incomes are not really related to operating. And then we are going to see some of those when we start solving questions. So other operating income will be added. And then when we add, these are the three key income sources that I mentioned. The net interest income, the commissions and fees income, and then the other operating income. And the three of them will give us our total operating income as a bank. Total operating income. So once we have our total operating income, we can now take away the operating expenses and then one other important thing, impairment of financial assets. I'm going to talk about that. So once we have our total operating income, we take out operating expenses. And the details of operating expenses will also be in the notes to the financial statement. And then after we have taken out the operating expenses, we take out something called impairment of financial assets. Now, financial assets will be, that is the loans that we have given out. You know, let me tell you one very interesting thing, that to the bank, loans are assets to the bank because they actually give loans to the customers, and to them they are financial assets, and the loans can impair. We subject these financial assets to annual impairment test, and once they impair, there are expenses. They come in as expense against the yearly revenue or annual revenue of the bank, but it is not included in the operating expenses. Even though it's also an operating expense, it is shown separately. It is shown separately. So you show your total operating expense with details in the note, and then you show any impairment of financial assets with details in the notes as well. So once you have taken out these two, your operating expenses and your impairment of financial assets, then you can have your net profit before tax. Someone will say, what about interest? Because we know that in the trading sector, businesses that are into trading would have said net profit before interest and tax. But here we are just saying net profit before tax because interest expense has already been taken off. This is a bank, so their core business is about interest, and therefore the interest expense, whatever you would have called interest, is already netted off before we had the net interest income. So when we get here, we are not going to take away any interest again because we've already dealt with interest. This is a bank, very different from that of the trading sector. So once you get here, it is your profit before tax, straight away, no interest. And then after profit before tax, you now take out your tax or your taxation expense, and then you have your net profit after tax. So you are done. Yes, you are done. So this is the format of the statement of profit or loss for a bank. Income statement of a bank. This is a very simplified format, but all these things, adjustments or details will be in the notes to the financial statement. And remember that banks are groups now. So going forward, we will look at consolidated financial statement of banks as well. Okay, but I mean, you need to understand the separate financial statement before you even think about consolidation. So we are looking at the separate financial statement, and this is how to prepare a typical profit or loss statement for a bank. And I am sure that this is very understandable. Now, having been able to understand this, we'll look at the next one, which is the statement of changes in shareholders' equity for a bank. Statement of changes in equity for a bank. So we prepare Statement of changes in equity for the year ended very similar to that of the trading business. To prepare the statement of changes in equity, it is similar to what you know already. So the total column will be shown. You leave a column for your particulars. You show for your stated capital. So let me create for stated capital, income surplus, capital surplus or evaluation, and then there is something called statutory reserve, which I will explain. Statutory reserve. Of course, there are other reserves that a bank could have on their equity, but I will explain the statutory reserve. And then there is, let me create a column for capital surplus or reserve, or contingency reserve too can be there. Then obviously the two key ones, the income surplus and the stated capital, cannot be overlooked, because those two are the most important or the key ones that will always be present. So we create a column. You know, these are components of equity for almost every company. Now, the stated capital is about the share capital. The income surplus or retained earnings is about profit. And then the capital surplus is about revaluation. Now, there could be other reserves for a bank that are quite different from what we know. Any other reserve could be created as part of the items of equity. But when it comes to what we call statutory reserve, now in every country, there is a central bank. And the central bank in Ghana is the Bank of Ghana. In Nigeria is the Bank of Nigeria. Now, the Central Bank of Ghana, for example, will always have regulations for the commercial banks and the rural banks and all the other banks. Now, there could be that regulation or that rule that commercial banks are supposed to keep a percentage of their reserve with the central bank. So the cash reserves that they have, it could be that the central bank will say, okay, you are supposed to keep 40% with us. And that becomes a statutory reserve. They cannot do anything about it than to keep that money with the central bank. So statutory reserve is the money that is part of your equity, but the central bank has decided to kind of lock it with them for safety reasons, for operational safety and other reasons. Okay, so that is what the statutory reserve is about. And so in every bank's financial statement, you are likely to see this statutory reserve in there, but there could be other reserves, so they can create as many reserves as possible. That is going to suit their operations, and that is going to extend the columns of the changes in equity. Apart from that, there is nothing new to learn here, because if you have watched my videos on published financial statement for companies, you will see that it's the same structure, and I'm going to use the same way to explain to you how to prepare the statement of changes in equity from for a bank, which is not different from that of the company. So I told you that in preparing the statement of changes in equity, we are only looking at how these components of equity has changed over the year. And so normally there will be an opening balance. So a balance brought forward for them. It could be throughout, it could be for just a few or one or two of them only. Then after your balance brought forward or your opening balances, you can pick them one by one and examine how they have changed over the year. So we begin with the stated capital. You ask yourself, was there any issue of share, whether it is a direct issue, a bonus issue, or whatever? All issue of shares will increase the stated capital. So assuming there was an issue of share, you just increase your stated capital. Then the most important part that changes a lot is the income surplus. So your net profit after tax, which we just computed, will be added to the income surplus. Any dividends to be paid or proposed will be subtracted from, and whatever you do will affect the total column. These things I have taught them already. That is why I'm rushing through. So the issue of share will also come to the total. Your net profit after tax will come to the total. Dividends paid is going out of income surplus. So that also goes as a bracket. And then if there is any other thing like a transfer, we can transfer money from income surplus to statutory reserve if there need be, or any other reserve. So we can say transfer. And if we are transferring from income surplus to statutory reserve, it will be a bracket here and it will be a positive here, and there will be dash at the total column. Because I have explained to you in our video on financial statements for publication that Transfers does not affect the total because it is a negative at one side and a positive. So the total effect will be 0. Now, when we come to capital surplus, usually it's when there is a revaluation of an asset. It could be an upward or a downward revaluation, and that will also affect the total. Statutory reserve changes when there are transfers to or transfer from whatever. So this is basically a statement of changes in equity, which is not different from what you know. I know I have really rushed through this, but I mean, this is something that most of you already understand. So it is not too different from what you know. It was the profit or loss statement that is quite different. And when I get to the statement of financial position too, there is a different thing that is coming in that I'm going to explain to you. So we just put our balance carry downs here, which is the final balances for the changes in equity. And then we are going to use these figures in the statement of financial position under the column of equity. So I'm done with the statement of changes in equity. Now, finally, I'm going to give you the format for the statement of financial position of a bank. Pay attention because there are some new things that I'm going to expose you to. And there are some things that is different from the way we do things with the manufacturing and trading sector. Okay. Now, we are on the statement of financial position. Now, we know that the statement of financial position is just a representation of the accounting equation. Assets equals to equity plus liabilities. And if there is any organization that goes strictly according to these three, it is a bank. Because for a bank, in their statement of financial position, they do not split the assets into non-current asset and current asset. They put all of them together as one. They don't split. However, they arrange it in the order of liquidity, and I'm going to explain to you. And then the equity follows together with them. The liabilities, they don't split into non-current liability and current liability. No. So for a bank's typical statement of financial position, it is strictly assets equals to equity plus liability. They don't split the listing of their assets into current and non-current. They don't do that. When it comes to liabilities, they don't split into current liabilities and non-current liabilities. Very interesting. So they go strictly according to these three. So we are going to have only 3 columns. Unlike the previous statement of financial position that we have been preparing, where we will have non-current assets before we have current assets, then we have equity, then non-current liability, current liability. No. When it comes to banks, it is assets. Then you get your total assets. Then financed by equity, liabilities, and that's all. Only 3 columns, and then we are done with the statement of financial position. Now, one other thing that I want you to know is that in listing of the assets, they list it in the order of liquidity. Now, even though they don't arrange it as current assets and different from non-current assets, they arrange the assets in the order of liquidity from the least liquid to the most, from the least liquid to the most liquid, or from the most liquid to the least. And most of the time what they do is that it is from the most liquid to the least. So the most liquid will always be cash. You see, just as we did for our current assets, where we said that inventory, receivables, and cash is in order of liquidity. Inventory is the least liquid, and then cash is the most liquid. You could have turned it upside down and said cash before receivables and inventory. Here, it is the most liquid first. So cash, so if it was in the case of a trading, it would have been cash before receivables in the short term, before any inventories, and then they will move to the non-current assets. But because over here they don't group them as separate headings, you see that the arrangement of the assets will be such that the cash will come and then it will descend, and the last item will be something like a PPE or a property, investment property or something. So it will begin from what you would have called a current asset to what we would have called a non-current asset. Okay, they arrange it in that order, but it is under the same heading. We don't group them into non-current and current. But if you are looking at the financial statement as an accountant, you can determine that this one is non-current, this one is current, based on your liquidity knowledge on arrangement of liquidity. So I'm going to clean this. I'm going to show you the format. We'll start with the asset, and I'll arrange the list of their assets based on liquidity. And some of the things that you will call a liability in a normal manufacturing sector or a trading sector, they will call it an asset here, and I'm going to show you. Okay. So we'll say statement of financial position, assets. So we'll show our currency sign with notes to the financial statement. Because we're going to show the note. And then we begin with assets. Highly summarized. Now, when it comes to assets, here we'll say cash. Cash and short-term funds, including those with Bank of Ghana. So including, I'm just adding that because normally the cash and the short-term funds are not only what they have in their hands, but even their cash with Bank of Ghana, if it is Ghana, or Bank of Ghana, if it is Nigeria, Bank of Nigeria. So it includes even those that are with the central bank. Let me say that. So including those at central bank. That is the first thing you will see on their financial statement. The cash and their short-term funds will be shown. And then from there, they record something like government securities. You know, the banks also invest in government treasury bills and other securities. So that comes in as an investment. It is a short-term investment. So it is very liquid. Remember that when we are talking about liquidity, short-term investments are treated as cash equivalents. So government securities, investment in government securities will also come as an asset to the bank. And then when they are done, because the banks deal with cash, they don't have anything with inventories of physical goods. So their cash and cash equivalent short-term funds will include first, including those they are cash at Bank of Ghana, and then the government investment in government securities will also come. And then from there, they will look at the money they have with other financial institutions. You know, banks could lend their money to other banks and other financial institutions, just as they also borrow from other financial institutions to give us loan. Other financial institutions and banks could also borrow from them. So another asset, what you call receivable from debtors, okay, receivable, they call it due from other banks and financial institutions. So due from other banks and financial institutions. So you see that the nature of their assets are quite different from what we are familiar with. They start with their cash and short-term funds, then the government securities. You see, I could have listed the assets anyhow, but after listing, you understand it better when I'm done. I'm trying to arrange the kind of assets they have in the order of liquidity. So when we are done, we'll look at it and test about what I'm talking about. So after they've recorded their monies that are due to them from other banks, then they can now talk about loans and advances to customers. And remember that I told you that loans to customers are an asset to the bank. If it was a manufacturing or trading concern, you would take loan to a non-current liability because you have gone to borrow. But here, the bank has not gone to borrow. They have rather lent. So to them, it is an asset. Remember, so loans and advances from loans and advances to customers, will come in as an asset. And someone will ask me, what is the difference between due from other banks and loans and advances? The due from other banks, they are trying to make it unique because this, even though both of them, they have given loans out, but this one, they gave it to other banks. So they try to separate what they have given to their own colleagues' banks from what they have given to their customers, because the interest rates they will charge the colleague banks will be lower than the interest rates they will charge the customers. So that is how come they try to separate that. And this is more liquid than the other one. That is how they have arranged it. So loans and advances to customers will follow as an asset. And then when they are done, the next asset they will look at is other investments. So investments. So when I say investment, this is here it was investment in government securities, which is very short term in nature. Here we are talking about investments in other long-term securities. So investments in general will come as an asset, and then from there they can talk about the physical ones like property, plant, and equipment, which is PP. And then if they have any investment property, it will also come. So you see that these ones are physical and tangible. So ladies and gentlemen, this is how, or this is the arrangement of assets for a bank, and these are examples of key assets that you find on a bank's financial statement, arranged in the order of liquidity. Now there are other assets that I may not have mentioned here. However, as we continue to solve questions, you realize that you meet other assets and you learn more. But this is just a format for you to understand. So you have your total assets here, and then you are done with the asset column. Then we can move to equity and then liabilities. So this is how assets are arranged. And you can see that the non-current assets are very last. In other words, they are least liquid. The most liquid begins. So it's in that order. Cash and short-term funds, investments in government securities, due from other banks are all assets to the business. Investment loans and advances to customers are assets to the bank. And then their PPE and any investment property will all appear here. So this is an asset. So once we are done with the assets, we can move on to the equity component, or financed by. So equity. Now, when we come to equity, we have already prepared statement of changes in equity. So those items that I listed, you just put them here and then you are done. So equity will have your stated capital here, and then your income surplus or retained earnings. The total on the changes in equity will appear. And then I also brought in capital surplus, which is also here. And then we show the statutory reserve. So that will give us a total. In fact, I use one underline because we are not done. It will be here, total asset. I use a double underline because we are going to have total assets against total equity and liabilities. So now that we have total equity, the next thing to look for is the liability. So let me complete that here. So we are continuing because of space. I'm coming here. So here, the notes will also be here. And I'll just say liabilities. Now, pay attention. Just as there was a surprise in the listing of the assets, there is another surprise that could appear in the listing of the liabilities. Now, with the assets, we realize that loans are now an asset because it's a bank. Now, let's go to liabilities and list them. We are not going to group them into non-current liability and current liabilities. Okay? Now, one key liability that you need to understand is customer's deposit. Do you know that the customer's deposit with the bank is a liability to the bank? When you are saving with the bank, okay, the bank to the bank is a liability. That is why they credit your account, because liabilities or creditors have credit balance. You are a creditor to the bank because they take your deposits and they use for business. So people don't understand why in the books of a firm debits are gains, but in a bank, when your balance is going out, we credit you, because to them you are a creditor and they see your balance as a liability. So all customers' deposits with the bank are liabilities to the bank because they must eventually pay when the customer demands it. So the first liability I'll mention here is customers' deposit. We can also, you see that we have due from other banks. The same way we can have due to other banks, we can also owe other banks. So due to other banks and financial institutions will also come as a liability. Details will be in the notes. And then we can have other payables or sundry payables. And then taxation will also come as a liability, of course. So let's assume these are the four liabilities or key liabilities that the bank may have. Customers' deposit, due to other banks, sundry payables, and then taxation liability. And here I have not arranged it in any particular order. Okay, the most important thing is to look at for the asset. So now we have our total liabilities here. So equity plus liability should give us the same value as the asset. So we call it total equity and liabilities. And so, ladies and gentlemen, this is the set, or let's say this is the statement of financial position format for a bank. Now, it looks a little cumbersome because most of you have been exposed to it for the first time. I'm going to solve a question with you in the part 2 of this lesson, where I'll take my time and then explain a lot more of these things. But for now, I just need you to appreciate that you have been exposed to financial statements of a banking firm. Remember to subscribe to this channel if it is your first time. Share this video, let others also have a benefit. And until we meet again for the part 2 of this lesson, it's bye for now. Thank you.